The market's relentless march upwards is actually a silent killer to your portfolio's long-term health. Rebalancing seems counterintuitive when things are going well, but it's the key to preventing catastrophic losses. Find out why ignoring this simple strategy could be costing you a fortune. So, what exactly is rebalancing your portfolio? Think of it like this. When you first invest, you decide how much of your money should be in different areas, like stocks, bonds, or real estate. This is your asset allocation. Over time, some of these investments will grow faster than others, throwing your portfolio out of balance. Let's say you initially wanted 60% stocks and 40% bonds. If stocks do really well, they might become 70% of your portfolio, while bonds shrink to 30%. That might sound good, but it also means you're taking on more risk than you originally planned. That's where rebalancing comes in. It's the process of bringing your portfolio back to your original target weights. In our example, you would sell some of your stocks and buy more bonds to get back to that 60-40 split. Why is this so important? First, it helps you manage risk. By selling high and buying low, you're taking profits from investments that have performed well and reinvesting in those that hadn't. This prevents you from becoming overexposed to any one asset class. Second, rebalancing helps maintain diversification. A diversified portfolio is less volatile and better positioned to weather market downturns. When your portfolio drifts too far from its target allocation, you lose some of that diversification. So how do you actually rebalance? The first step is to set your target asset allocation based on your risk tolerance, investment goals, and time horizon. Once you have that, you need to monitor your portfolio regularly to see if it's drifting too far from those targets. Many investors use a threshold, like 5% or 10%, as a trigger for rebalancing. For example, if your stock allocation goes above 65% or below 55%, it's time to rebalance. When it's time to rebalance, you have two main options. You can either sell some of the overperforming assets and use the proceeds to buy underperforming ones, or you can direct new investments into the underperforming assets until you reach your target allocation. Often, it's a combination of both. Keep in mind a few things. Every time you buy, you sell investments. There may be transaction costs. Also, selling investments can trigger tax implications, especially in taxable accounts. Consider these costs when deciding how frequently to rebalance. Some investors rebalance quarterly, others annually, and some only when their portfolio deviates significantly from their target. There is no one ideal timeline. It should depend on your personal financial planning. Also, before starting your investments, make sure to do your historical data analysis. You don't want to buy high and sell low because of a faulty capital and expense ratio. Also, consider the efficient frontier for systematic approach to your investment strategy. It's all about having the proper data to ensure long-term growth while minimizing short-term losses. Rebalancing is a crucial part of long-term investment strategy. It's not about timing the market or chasing the highest returns. It's about staying disciplined, managing risk, and sticking to your financial plan. Now, one aspect we didn't fully explore is the impact of different rebalancing strategies on Sharpe ratio and drawdown. Further research could analyze which methods provide the most efficient risk-adjusted returns. Also, the video has not touched based on the concept of rebalancing with asset location. If you found this video helpful, please give it a like, share it with your friends, and subscribe to our channel for more great financial content.